In the previous lesson, we covered certain details that make up general obligation bonds, or GOs. Now let's explore revenue bonds, another popular type of muni market issuance. Revenue bonds are generally debt instruments used to finance certain revenue-generating projects that reside within a state, local government, or other municipal authority. These may be used to help fund construction or improvements at airports, water and sewer systems, hospitals, bridges, and a host of other types of facilities. Unlike GOs, payments to holders of revenue bonds are not sourced from taxes, but from the cash flows generated by these projects. That makes revenue bonds typically riskier than GOs should these revenues fall short of the requisite debt service funding. To make principal and interest payments to bondholders, an issuer that sells a revenue bond to build a turnpike, for example, would likely use toll payments or user fees as its source of funding. If those revenues are not enough to fund the debt service, the issuer may face default on payment to its bondholders. Elsewhere, revenue bonds may also be offered as alternatives to GOs. This can occur in situations, for example, when an issuer fails to acquire voter approval for a GO, or when the municipality's debt ceiling has been reached and GO issuance has been restricted. When you consider all of the various needs of a municipality that have the potential for generating revenue, you would find there are several different types of revenue bonds underpinning their financing. Some of the more typical types of revenue bonds include housing revenue bonds, which are typically sold to help fund housing for lower-income households. Healthcare revenue bonds, which are typically used to help finance the construction of nonprofit hospitals and healthcare facilities. Transportation bonds, which are used to fund projects such as bridges, tunnels, toll roads, airports, and transit systems. And industrial development revenue bonds, which are generally sold by a municipality to build facilities for private companies. Other types of revenue bonds include education bonds, moral obligation bonds, utility bonds, and special tax bonds. Before investing in a revenue bond, a bond investor may want to analyze several factors about the issuer. Remember, for revenue bonds, investors are repaid from the cash flows generated by the constructed project, not by tax receipts. Potential buyers of revenue bonds would therefore want to compare the project's revenue streams to the amount of debt service required to pay the bondholders. Whether items such as operating and maintenance expenses need to be deducted from the revenue calculation, whether the project's feasibility study lists any impediments to the project's cash flow, and if the debt service coverage ratio, the amount of available revenue versus the required debt service amount, is sufficient. Let's take a closer look at a revenue bond that's intended to fund the construction of a turnpike. Recall that the source of the project's cash flow will likely come from toll payments or user fees. Let's say the turnpike generates annual gross revenues of $6 million and requires $1 million of annual operating and maintenance costs. This brings the annual net revenue to $5 million. Meanwhile, the issuer is obligated to pay $2.5 million in debt service to its bondholders. To determine the debt service coverage ratio, all you need to do is divide the net revenue, $5 million, by the debt service requirement, $2.5 million, which in this case results in a ratio of 2-to-1, which is sufficient. Many bond investors will also likely look very closely at the revenue bond's indenture, also known as the bond resolution or trust agreement, for those provisions that detail the issuer's responsibilities in the transaction, as well as the rights of the bondholder. In short, these provisions comprise the contractual obligations or covenants set forth for both buyer and issuer. The indenture should also spell out how the revenues from the project will be dispersed, which is commonly known as the bond's flow of funds. The bond resolution will include these funds, which are established as repositories for specific costs, such as for debt service, operation and maintenance, renewals and replacements, construction, as well as a sinking fund. Now that we've covered general obligation bonds and revenue bonds, which typically offer longer-term maturities, we'll next take a look at some municipal securities with shorter-term tenors. We look forward to seeing you then.